Hello everyone, welcome to Study IQ. So we will continue our discussion on economy. We have actually started off with the module monetary system in India, and in the first session we have talked about what is money. We have also seen the functions of money. We have discussed about different types of money, and in that we have discussed about evolution of money, starting from the commodity to commodity exchange system, that is a barter system, and then till token system, token money we have discussed. So it was firstly commodity to commodity exchange, and then the full bodied money concept we have discussed, and then representative full bodied money we have discussed, and finally we reached up to token money. And we have also discussed about different other types of money like legal tender money, fiduciary money, near money, all those things, plastic money, everything we have covered. So in this session we will be talking about the different types of bank accounts, because we are going to discuss about most important concepts which is required for prelims, that is different concepts of money, M1, M2, M3, M4. So different important concepts of money supply is what we are going to discuss in the next session. So as a prelude to that, in this session I'll be talking about different types of bank account, and I'll make it clear that these elements only will come in M1, M2, M3, M4. So you need to understand what you mean by demand deposit, what you mean by time deposit, what you mean by net demand time deposit, all this NDTL, net demand time liability, all these things we need to understand it in a clear way. So here I am spending some time for making you understand the different types of bank account. It might be easy for most of you. So different types of accounts. I'll start with savings account, then fixed deposit or the recurring deposit also we'll discuss, and then we'll move to current account. Or rather what I'll do is I'll make 3 columns and we can discuss it faster. Okay, so first start with savings account. Anybody can open savings account. It can be a student account, it can be a salary account, it can be a joint account. So everything will come in this, and then we will talk about current account, and then we will also talk about fixed deposit or recurring deposit. What is the difference? In case of fixed deposit, a lump sum amount is deposited in one go, whereas in case of recurring deposit, over a period of time the amount is deposited for a fixed period. In both cases, what is common? It is deposited for a fixed period, but lump sum amount in the fixed deposit and recurring deposit, over a period of time amounts are deposited. Okay, so in case of savings, we'll start with this. Now the question is, who saves? Firstly, who's using these different types of accounts? Households. Most important savers are households, so they start savings account. So the savers, right? What about current account? Current account will be by the business entity, right? So it can be a person or a firm. So it can be a person or a firm. Different type of business entities we have discussed, that proprietorship, limited liability company, the partnership forms, limited liability partnership, all this we have discussed in one of our previous session. So here the business activity or business entity, fixed or recurring deposit, anybody, all, but usually households, mostly it will be households. Now what about restrictions? Can you make all transactions every day? You can make transactions or unlimited transactions in savings account? No, there are some restrictions in transactions when it comes to savings account, whereas you won't find any restrictions in current account, but there will be very restrictions, too much restriction. You can't do any transactions in the fixed deposit because it is deposited over a period of time. Okay, so you can write here some restrictions like number of transactions, the amount withdrawn, number of transactions or the amount withdrawal, etc. Now here no restrictions in current account. There won't be any restrictions in the current account, so no restrictions. Okay, so that means any transactions can make in this account, and this fixed, it is totally restricted. Okay, now what about interest? So if you see, interest is usually low when it comes to savings account. Some interest is given like 4%, but different banks are given their option. So different banks, they can choose what interest they have to give. RBI will give the basic guideline. Okay, so interest usually low. So it is actually fixed by whom? It is fixed by the banks only. From when? 2011 onwards. So from 2011 onwards, fixed by banks. Okay, so RBI fixed the minimum rate of interest, that is 4%. So RBI fixed the minimum, that is 4%, and above that, whatever the banks can afford to give, they can give, right? Different banks are giving different rates. Yes Bank is giving different rate, Kotak Mahindra Bank is giving different rate, SBI is giving 4%. Okay, so different banks can fix from 2011 onwards. Till 2011 it was fixed by RBI. So now it is different for different banks. It is not common. In case of interest, in case of savings banks, it is different for different banks because it is fixed by banks. But this question was asked in 2010 or 2009. This question was asked, who's fixing the interest on savings bank? So at that time it was fixed by RBI, but now it is fixed by the banks, different banks. So if you see the question banks and all, that time the correct answer was RBI, but that doesn't mean that now it is RBI which is fixing the interest for savings bank. RBI is giving the basic rate, that is 4%. Above that it is fixed by the banks only. So what about current account? There is no interest. No interest. There will be some service charges obviously for this, and here interest will be relatively high in case of fixed deposits. Okay, so interest will be high. So it is a tenor premium. More the tenure, more years if you are investing, more time you are investing, more interest you will get. More time you are depositing, more time you are giving, more interest you will get. So what kind of liability are this for banks? Different accounts. So you can see here, as I have already told you, some restrictions. So there are some demand liability and some time liability here. Demand liability and time liability. Both are there because it is not necessary. Let's suppose you invested 10 lakhs. Immediately on one go, you cannot withdraw entire 10 lakh, right? Some restrictions will be there. Okay, so some amount you can withdraw on demand. So demand liability is there from the bank side. Your deposits are liability. If you see the balance sheet of the bank, your deposits will be the liability of the bank. So demand liability is there and time liability is there. Some restrictions will be there. So some portion will be time liability of the bank. So in savings account, both type of liabilities are there, demand liability and time liability. Whereas in current account, any transactions, no restrictions, so it's completely demand liability. Demand liability. Whereas in case of fixed deposit or recurring deposit, it is time liability. After the particular time, after that maturity period only, you can get the money. So it is time liability from the side of bank. Okay, now we need to understand the concepts of demand deposits. Okay, so what is demand deposits with the bank? Now you can see here there is a demand deposits. You can see here and here, right? So these are demand deposits. Upon demand you have to get the money. So can I say entire current account? You can see entire current account is demand deposit and part of savings account is demand deposit and part of savings account is time deposit. So demand deposits with banks, I would say the entire current account plus demand liability portion of the savings account. So demand liability portion of savings account. Okay, then what is time deposit with the banks? You can see here this is time deposit, entire fixed deposit and the time liability portion of savings deposits. So TD, that is the time deposits with banks, that is the total fixed deposit and recurring deposit that will come together, and then this one time liability portion of savings account. So time liability portion of savings account. Okay, so this is what time deposit. Now both together is what we call as the total bank deposit. So TD plus DD, that is a time deposit plus demand deposit, is the total bank deposit. Total deposit, what is that? It is also known as total demand and time liability, right? So demand liability and time liability is what your total deposit, right? So this is your total deposit. So total demand liability and total time liability is what your total deposit. Okay, so you understand here, I'm writing here total demand and time liability. We are not writing total liability. See, total liability is entirely different. You see here, you may think that this is a total liability, right? But this is not the total liability of the bank. This is it is related to deposit. There is a time and demand liability. So we are making it specific that total demand and time liability. Why we are not writing total liability? Even though we are writing total deposit, we are not writing total liability. The reason is bank's liability is not just the deposits. The liability side, if you see, it is much more. Okay, there are the salaries of the employees, the infrastructure, the equipments, and all these are part of the rent of the building. Everything is actually liability of the bank. So when we talk about liability, many things will come. So we are making it specific that the total deposit is actually the demand and time liability. Okay. It is not that the total deposit is the total liability. Making it very clear, total demand and time liability. Now let's look into the post office banks or post office saving organization. Post office banks or post office saving organization. So what is the objective here? Unlike banks, the objective here is financial inclusion. In case of banks, the objective was profit. So the operation will be entirely different here. So objective is financial inclusion. Means it is the welfare which is considered most important here. It serves the poor and the vulnerable, whereas in case of bank, the objective is clearly profit. So the operation, the methods and everything will be different here. Now what type of accounts you can open in post office? Can you start a savings account? You can obviously start a savings account. Okay. Can you start a fixed deposit? You can start a fixed deposit. Can you have a recurring deposit? You can have a recurring deposit also. So savings account is there, fixed deposit is possible, and recurring deposit is possible. Can you open the current account? Current account, can a business entity go and open a current account in the post office? No, this is not possible. As I've already told you, from the objective itself, you can understand it is for financial inclusion. It is to serve the poor and the vulnerable, not for the business entities. So this is actually the difference between banks and post office banks. Okay, so you cannot start a current account in the post office. So they also provide limited value added service. They provide limited value added services like when it comes to banks, there are many services, right? The bank locker, the ATM withdrawal facility, the SMS messages, internet banking, and all these facilities are actually provided by banks. But when it comes to post office, you won't get that much value added services. What is the ownership? Who is the owner? Ownership, it is Government of India. Okay, so it is actually a departmental undertaking, and that means if you are an employee in post office, you will be called as a government employee. Whereas if you are an employee even in a public sector bank, it is a company, it is registered under Companies Act, so you will be considered as a bank employee only. You won't be considered as a government employee. That is public sector, this is departmental undertaking. That difference is clear, that we have already discussed before. So there is a departmental undertaking. Now, in case of banks, bank lend money. In case of post office won't lend money. Okay, the entire money is actually used by the government and it will go to the public account. So post office, no lending, and you can't get loan, no loan. So government use the money, and this is part of the government internal debt. Okay, so government public debt. So if you remember, last year there was a question related to external debt. In that, the question which was asked was, with respect to the external debt, consider the following statements, and in that it was asked the government debt was more. Actually, government debt is very less when it compared to external debt, but when it comes to internal debt, it is more. And government is having maximum internal debt than external debt. So out of the total external debt, if it is 100%, 80% is actually private in terms of ECBs and various other borrowings. Okay, and 20% is only government. But government is having huge internal debt. Public debt is very high, But that doesn't mean that in the external debt, government contribution is high. In the external debt, it is the private sector contribution is actually very high. So if you know the statement, you could have answered. If you know this concept or this information, you could have answered that particular question very easily. Okay, so I hope you understood this. Now let's move on to money supply. Very important concepts. Money supply. So here only we will be discussing about different types of money. I'll just start with this now, and then we will discuss in detail in the next session. We'll discuss about M1, M2, M3, M4. What all things will come in different M1, M2, M3, M4. What is narrow money? What is broad money? All those things we'll discuss. What is the most liquid money? What is the least liquid money? Everything will have to be covered because questions asked every year in prelims from this particular topic. Okay. So what is money supply? Let me write down the definition first. It is the total stock of all types of money. That means currency with the public, currency and deposit money both. Okay, all types of money, currency and deposit both will come, held by public. I'll explain this term public. Okay, public at any point of time. Now what is this term public? This term public includes all economic entities except government and bank. Why we are excluding government and bank? Government and bank are the creators of money. Okay, so public means except government and bank, excluding everything will be part of public. So money supply is actually what? Money supply is actually currency, total currency plus deposits with the banks. Okay, now you see that the deposits and credit will be almost equal. From the deposits only banks give loans. Okay, so almost all deposits will go as loans apart from some amount which is kept in terms of some cash reserve ratio and etc. Otherwise everything will go in terms of loans. So deposits and credit will be almost equal. So this term you have to understand, public except government and bank, every economic entities will come here. Now when I talk about RBI, RBI is part of government. So RBI, you cannot go and start an account in RBI. RBI is not a bank like any other bank, right? So RBI is actually part of government bank. So RBI is a money creator, maker of money, and here banks will create the credit. Okay, so RBI create money, banks create credit. So you need to know the credit creation process. I'll explain the credit creation process now. So credit creation process is like this. Credit creation process. So first the money is printed by RBI. So government use that money to buy something from, let's say, person A. So government use, let's say, rupee 100 to buy something from A, and A will deposit this money in, let's say, State Bank of India. Okay, so he deposited this money in State Bank of India. So what SBI will do, SBI will keep mandatory statutory requirements, keep 20% with SBI and then lend rest of the 80%, let's say lending it to B. Okay, and what B will do, B will buy some item from C. Okay, so B bought some items from C and C will deposit this money in some other account. So let's say Punjab National Bank, C will deposit this. Okay, so out of this 80 rupee which is deposited by C, let's say 20% will be kept with bank, that is 16, and then rest of the 64 will be lending to some other person D. Okay, so PNB is lending this to D, and this D will buy some items from E, and E will deposit this in ICICI. Okay, and ICICI will keep 20% of this and lend rest of the amount. So this is how the credit created in the market. So effectively money printed is 100, but you can see here he firstly this person is buying an item worth 80 rupee. Now this person is buying an item worth 64 rupee with the same money. So effectively the money, it is the concept of money multiplier I'll discuss in the next session in detail, but here effectively 100 rupees printed, it is having a value of 560 in the market. Okay, so money multiplier is actually 5.6. So 100 rupees printed by the government and circulated in the market, it is having an impact of 560 rupee in the market. Okay, so this is what credit creation process in detail I'll discuss in the next session, so that you'll understand it much better way, because for that I need to talk about reserve money, I need to talk about M0. So here I don't have time to discuss about different concepts, M1, M2, M3, M4. We'll discuss that in the next session. Okay, so here we are talking about money supply. Just understand money supply is actually this one, currency plus deposit. It shows what? It shows the total purchasing power. It shows the total purchasing power. It shows the total purchasing power in the economy, as it includes currency and both bank deposits or credits. Both are same. Deposits will go as the credits, as I have already told you. Okay, so if you have any doubt, you can get in touch with me here. This is my Instagram ID. You can join the Telegram channel for all the videos. So see you in the next session. I'll talk about all the concepts related to money supply in the next session. Just that you need to understand the different types of account, because for example, when I talk about money supply M1, I'll be talking about currency with the public. So you need to know what is this currency with the public, and then I'll talk about demand deposits. So you need to know what are the demand deposits. I've discussed about two different types of demand deposits. Okay, so the current account is part of demand deposit, and some portion of savings deposit. Savings account is also demand deposit. And then I'll talk about some other deposits, the other deposit which is held with RBI by some important persons like RBI, ex-governor of RBI, president, etc. Okay, some deposits will be there for those people, so that will also be counted in M1. Like that, we have to discuss about different concepts. So you need to have a better idea about what is DD, what is TD, what is total deposits. Okay, what is the total demand, time, liability. So make it clear. See you in the next session.